What's up, you guys? Welcome back to Unorthodox Savings. Joe here, and right now we're 3 days away from the elections. By the time I'm recording this video, the market's in a free fall. I'm sweating bullets. People are yelling at me,
Bert, you're shouting again, Bert.
and I just don't know what to do. So with this video, I'm going to show you my top 10 best ETF investments for 2021. These are ETFs I've invested in the past, ETFs that I like, and this is going to be a video for any type of investor for any type of risk management they want to choose. One thing I have to get out of the way is I am not a financial advisor or certified in any shape, way, or form. I just want to get that out of the way. This is what I do personally, so I'm not telling you what to buy, I'm not telling you what to do. So if you guys go do something, do not come back here because I'm just going to go hide. One thing I preach a lot on this channel is having a diversified portfolio. The reason why is because if one session does very bad, you don't lose a lot of money. If one section does very well, you also get the opposite end because you don't really earn that much money. So then as an investor, you have to figure out where you want to balance that out. How much do you want to risk? So in this video, I'm going to give you 10 ETFs, 5 of them being growth ETFs that grow up in value, and the other 5 being for your dividend investors who want to get paid monthly, quarterly, or yearly. Now for my short-term traders, such as swing traders, day traders, things like that, I did not forget about you guys. You guys will be getting a video shortly, but this is for my long-term investors who want to have a retirement portfolio or something that's a little bit more passive, who just don't want to put all that much effort because they have other things they're focusing on at the moment. So for those of you who do not know, there are over 2,000 ETFs to choose from. An ETF is an exchange-traded fund, which is just a cool way of saying that there's a certain portfolio that owns a bunch of companies and you invest into that company. So they have expense ratios, they have dividend yields, which is what you get paid as monthly. And I'm going to go over all of this, so let's hop into it right now. So number one on the list, I have one of my personal favorites, which is called VT. And VT is like owning the entire world. Any company, any business, you are going to own it. And this is basically, if you're an investor, you want to look at this as what is the world going to do 30 years from now? Now, I'm not trying to be pessimistic in this video, but who knows where the world's going to be 30 years from now. But this being said, it's a very well diversified ETF, probably the most diverse out of all of them. It only has a 5.7% return yearly, while the US markets have around a 7 to 8% return yearly. Now, it does have a 0.08 expense ratio, which is pretty low for an ETF, so it's not all that bad. But there's been different studies on either side saying that the US markets perform better or that the world markets perform better, and that's a personal choice you have to make. Number two is a very, very popular ETF called QQQ, and it has an expense ratio of 0.20%, which is more pricier for the other ETFs, but it's for a good reason. So this ETF owns a lot of the popular stocks you see today, and even the investment breakdown, which I'll show up here on the screen, it owns a lot of the sectors that you would think are important if you knew nothing about investing, which is why so many people invest in it today. So to break it down, it has 47.35% in technology, which are your big stocks like Apple, Tesla, IBM, etc. And then it has 20.80% in telecommunications, 14.70% in consumer discretionary, 7.23% in healthcare, 5.98% in consumer staples, and then 2.68% in industrials. So back in the early 1900s, probably around the World War II era, their version of this was investing into steel and different metals and things like that, because obviously that was what was booming at the time. And nowadays, it's just that ETF is mainly just safer for like your dividend yields and things like that. So it's not as much as a growth ETF. Now this is more of a riskier ETF. This being said is because if you look at the chart, it's just going up. The only way is up. So you never know with stocks and ETFs like these, are these going to drop randomly? Is there going to be a big change in technology? As you guys see over the years, there's always the newest iPhone, the newest console, different things like that dropping faster and faster. And that being said, it's harder to keep up, harder to catch up in the direction of where we are going. Number three is an ETF I didn't really want to talk about because it's so popular on YouTube, but it has to be said because it's still a great ETF to invest in, and that's called ARK, which is ARKK, and it's a very unique ETF. And the reason this is because there's a human actively managing the ETF, which means they are buying and selling for us, where otherwise it's a supercomputer or an algorithm set for a certain sector. Well, to make it sound simple, it's a woman named Kathy Wood, and she's just sitting going, I want this stock, I want that stock, and I like her a lot. She's a Tesla fangirl, and most of the portfolio is Tesla, which ended up letting this ETF beat the market by 65% this year, which is extremely good. Now, this ETF is riskier than QQQ and others that I'm going to talk about, and the reason why is because most people cannot beat the market year after year after year. So if you're a long-term investor, I'm not too sure what this is going to do in the next coming years, but as of right now, it's a very, very good ETF. Now, because this ETF is managed by a human, the expense ratio is a little bit higher. This does not mean that Kathy is getting the money, but the expense ratio is 0.75%, which is $75 for every $10,000 invested, which does not seem a lot, but when you have a lot of money invested, this adds up a lot. Number 4 is a personal favorite of mine because it's in my retirement portfolio, which is called VU. And VU is the entire S&P 500. It's one of the staple ETFs that basically everybody knows. As a new investor who goes sit down with a financial advisor, they usually bring up this ETF, and that's because the top 500 companies in the United States you invest in, and it's usually heavily funded into like the top tech stocks as of right now, but this changes over time. And the reason to why people like this ETF so much is because the expense ratio is very low at 0.03%, which is very good for the long term because you're not dishing out a lot of money as you invest. And number 5 goes hand in hand with VU, and it's called VTI, which is also in my retirement portfolio. These two are some of my largest holdings as well, and the expense ratio is also very low. Now, I like owning both of these things because you can pick up any item, and I'm going to pick up my favorite one back here, and say I own 0.001% of this, in any store you walk into, and you're going to say and call it out. Now, I would not recommend leaving or doing anything dumb with these items because you do not actually own them, but it's a cool flex because when you own both of these, you have every single CEO, businesswoman or man working for you to make you money. Now I'm going to switch over to the dividend side of the ETFs, and the dividends pay you monthly, quarterly, or yearly. And this is cool because when you invest into this, you put your money, it sits there, and they pay you just for keeping your money there. And people use this money over the long term to pay for their bills and different things like that. So coming in at number 1, we have Noble. Noble is a very good ETF for dividends because in this ETF, every single company has grown their dividend for 25 years or more. Now, the dividend yield is only 2.2%, which is pretty small, but in the last 5 years, they have grown their dividend by 12%, which is a lot for an ETF. Now, their expense ratio is 0.35%, which is more pricier for an ETF, but with the growth of this ETF, I think it's worth the investment in my eyes. Number 2 is one of my favorites. It is a tank. It cannot be stopped, and it's called SCHD, which is the Charles Schwab US Equity Fund. And this is an amazing ETF for just about every single reason. It has a dividend yield of 3.3%, which is very good, with an expense ratio of 0.06%, which is even better because it's low expense ratio, high dividend yield. In the last year alone, it has grown its dividend by 20%, which is amazing. And on top of that, the growth, so the overall price of this ETF has gone up a lot over the years and consistently. So it's the best of all worlds. So number 3 is called VIG, which is a Vanguard Appreciation Fund. Now, this ETF is a little bit different. It has a 1.8% yield, which is pretty small, but it has a huge growth rate, more than any other ETF I've shown in this video for dividends. But this ETF is important because all the companies in here have had their dividends grow for 10 years or more, which is very consistent, and as well as its dividend yield growing, its overall growth rate's growing very fast. So this is more of somebody who wants the best of both worlds, but a little bit more growth, but still wants to get paid holding on to this ETF. Now, number 4, I'm very biased about because this is one of my personal favorite ETFs. I invest a lot of money into this, and I'm going to start rattling off the reasons right now. It's called VYM, which is a Vanguard High Dividend Yield. The yield returns around 3.5% a year, which is really, really good, with an expense ratio of 0.06%, which is really, really good. And then it's also returned 6.7% a year, which is basically the same as US markets because, like I said, it's 7-8% return. So this thing just does it all. It just can't be stopped. It makes me mad because it doesn't make sense. And whoever made this ETF just said, F it, I'm gonna buy them all, because this ETF holds 428 companies, so it's very well diversified on top of everything. Now, number 5 is a very popular ETF, and this is because of YouTubers, this is because of Robinhood, and overall, it is a good ETF. I have no complaints about it at all. It's called SCHD, and SCHD, a lot of investors like because it has a 5.5% yield, which is very high, but it has a 0.30 expense ratio, which is also pretty high. But the reason why investors like this so much is because it pays monthly. A lot of investors hate having dividends come in quarterly, bi-yearly, or yearly, because if you're living off your dividends, it's more difficult to budget your money 4 times a year or yearly into one sum. So having a monthly payment is very convenient, which I understand. But I will say, if the markets continue to dip, I will be buying SPHD because I think that's a very good buy if it hits a certain price. Now, my target price, which is the 52-week lows in the 20s, is probably going to be around there. I say around $25 to $26. And that's if the markets continue to drop, because right now it's just shaky because it's a week before the election. Now, I want to end the video off with one last piece of advice. So before you click away, please listen, because this is the most important thing I'm going to tell you. If you're a newer investor and you leave this video to go look at these ETFs, you're going to find other ETFs. Now, the yield's going to be like 15% with an expense ratio that isn't all that bad. And I just want to give the personal piece of advice is that you should do your own research to see what companies these ETFs hold, because 8 times out of 10, there are going to be newer companies that are way riskier, or companies that aren't safe to invest in, and their yields are very high because they want investors to invest in them, and it's a whole mess. Now, you can't, like I said, there's 2,000 ETFs out there in the world, so you can invest in anything you want, and there's literally an ETF for anything you could want, but some of these are very risky. Now, some of the investors out there invest into REITs, which is your real estate investment trust, and some of them are good, some of them are bad. I have no problem with that because some people don't like to work in real estate and they invest in them. So a lot of your real estate ETFs have a higher yield. But as of right now, the real estate markets are shaky. So you might find like a little bit of shift in price. Now, I'm not going to get into the real estate part of this, but you're going to find other ETFs of companies you've never even heard of and sectors that you know nothing about. But you know, the 12% yield looks really enticing, but a year later, your money can just go. So that's just my one piece of advice that I wish somebody told me when I first started investing, because I had made that mistake, and that was years ago, but I wish that I knew that in the beginning because I would have saved a lot of money. So that's all I have for you guys today. I hope this provided value. These are my top 10 investments for 2021. I feel like these are the ones that are going to do better, stay more stable, and I hope I got around to all the risk levels and different types of investments that people could want to make. So thank you guys very much for watching. Please like and subscribe, and I'll see you next time.